All right, on to our last topic in this chapter, disposal of plant assets. So remember we were talking about the life cycle of a plant asset. At the beginning, we buy it. Throughout its life, we record depreciation using one of those three methods we talked about. Now we're at the end of the asset's life. At this point, we dispose of the plant asset. Okay, so we're going to remove asset from our records. Now, there's a couple different ways that we can dispose of a plant asset. We can what's called retire the asset. We can sell the asset, or we can exchange the asset, right? Think of it as like a vehicle. You have an old car you're trying to get rid of. You can retire it where you just donate it. You don't get anything in return. You can sell it where we get cash in return. Or you can exchange it where you get some other asset in exchange, like trading in an old car towards a new one. Okay, this last one, the exchange, it's a bit more advanced. You cover that in a more advanced accounting class. In this intro class, we look at the first two scenarios, and I specifically am going to look at the second one, selling the plant asset. Because if you can do a sale, you can do a retirement. Sale is a little more complex because it involves cash, whereas a retirement does not involve cash. Okay. So the journal entry to record specifically a sale. So to record sale of a plant asset. We'll say equipment. We'll pick one, right? One of these categories. Sale of equipment. All right. Well, we said if it's a sale, we get cash. To show an increase in cash, you debit. Okay. Let me give us a little more room. Debit cash. Think of what we're selling. An asset, right? Equipment. Assets normally have a debit balance, right? So to remove it, we're going to have to credit equipment. So we have an amount in our debit and our credit. Now, remember that contra account, accumulated depreciation, that contra asset account? Okay, if we remove the asset, you have to remove the contra account. It goes anywhere the main account goes. So to remove a credit normal balance, you are going to debit accumulated depreciation. Okay, now I left a little bit of room, not much, but a little, because you may have either a loss on the sale or you might have a gain. Okay, that we will have to calculate. You'll have one or the other, not both, obviously, one or the other. All right, if you have a loss, you will debit it, and it will appear in the other losses and expense section of that multiple step income statement we saw in chapter 6. If you have a gain, you will credit that account, and it will appear in the other gains and revenues section of the income statement. Okay, so let's talk about how we know if you have a gain or a loss. All right, so to calculate gain or loss, you are going to compare the cash received for the sale. You're going to compare it to the asset's book value. We've seen book value quite a lot this chapter. I know it was chapter 4 when we originally saw it, but we have been using it heavily in this chapter. As a reminder, book value is cost minus accumulated depreciation. If your cash received, if cash received is greater than book value, you have a gain. If the cash received is less than your book value, you have a loss. Okay. So that's how you would calculate whether or not you have a gain or a loss. All right, let me map out the journal entry for us one more time. We said you're going to debit cash. The nice thing is this amount is given. You're going to credit, in this example, equipment. It could be, of course, building, land improvements, and that has to be credited for the initial cost. The only tough part is accumulated depreciation. You have to calculate that. And of course, whether you have a loss or a gain, let me put it up here, or a gain, you're going to have to calculate. Calculate by comparing the cash received to the assets book value. Okay. We'll try an example on the next slide. Actually, I'll make a separate video. Why not? Okay, so have your notes handy and then we'll work through an example.